Welcome, deep divers, to another session. We're TalkTickers, your shortcut through earnings season noise. Today we're tackling something interesting. A global packaging leader just reported. Management sounds confident, talking strategy, transformation, but the market reacted pretty sharply. Shares took a tumble. So our mission today is to figure out that disconnect. Why the reaction? What's really going on under the hood? You've seen the headlines, the numbers. We're here to give you the context, the story behind it all.
Exactly. Those top-line numbers always get the first look, don't they? But the real value, it comes from digging into the strategy, what management is really thinking, and how it all connects. That market drop definitely sent a signal about sentiment, but there's usually more to it.
All right, let's dive straight into those numbers that caused the stir. Fiscal year 2025, fourth quarter, adjusted earnings per share came in at $0.20, so a near miss. Revenue was $5.08 billion, also a bit light compared to the $5.17 billion consensus. So yeah, just off on both top and bottom lines.
Right, but that miss needs some unpacking because, reported revenue, it looked huge, up 43.8% year over year. But, and this is the key thing that was almost all driven by this massive acquisition they just did. If you look at it in constant currency, take out the deal impact. Revenue actually declined 2% year over year.
Okay, so the legacy business is softer.
That's what it suggests. And overall volume, combining both legacy businesses, was down 1.7% year over year, weaker than they expected. So it's not surprising the market reacted the way it did, looking past that big headline growth number. Shares dropped noticeably.
Okay, right. Let's unpack that.
Yeah.
Because despite the Q4 miss, despite the market reaction, management sounded, well, pretty confident. They jumped right into talking about the big strategic move, integrating Berry Global. And what's really striking is the timing. The deal only closed April 30th. So this earnings call was really the first proper look at the whole combined company. That's a huge integration to manage.
Oh, absolutely. A massive undertaking. And it shows how urgently they view this. They're framing this, they're calling it a scale plus innovation play. The idea is to build this truly global packaging giant. Broader materials, bigger customer reach.
Scale and innovation.
Yep. And they really stress the cost savings, the synergies they expect. Plus, accelerating innovation, combining the R&D efforts. It's not just about size, it's about efficiency, new products. Getting that scale seems crucial now in packaging, might reset the bar for others. And they're moving fast, already 100 days in, talking to customers globally about what this new combo can do.
And they're already seeing some results, some early wins from combining things.
Yeah, they highlighted that, pointed to providing membrane lidding for coffee capsules. The capsules come from the berry side. Now they can add the lid, a complete package.
Right, a full solution. That sounds like a good selling point.
Definitely. And operationally, they haven't wasted time either. They've cut duplication, reduced headcount by over 200 already.
Wow.
And starting on the footprint optimization, closed one site, approved closing 4 more, combining assets, shifting production around, standard integration stuff, but happening quickly.
Like cleaning out the garage, as you said, getting rid of the duplicates.
Exactly. And on procurement, getting all the spending data together, working with suppliers for quick wins. Those should start hitting the P&L this fiscal year.
And speaking of earnings, they stuck to some pretty ambitious synergy targets. They're aiming for $260 million in synergies this fiscal year, building up to $650 million total by fiscal 28. That's a big number.
It is. And that $260 million for this year, mostly cost savings, a bit from finance like interest and tax.
But, we hear about big synergy targets all the time. Sometimes they don't quite materialize. What makes you think this time might be different? Or should we be skeptical?
That's always the right question to ask.
Right.
I think the speed of the initial actions is encouraging. The headcount cuts, the site closures within 100 days, it suggests they had a solid plan, not just wishful thinking, tackling the easy stuff first. And that confidence, I think, feeds into their guidance for fiscal 2026. Despite that Q4 miss, they reaffirmed adjusted EPS growth of 12% to 17%, projecting $0.83 per share and free cash flow. Expected to double compared to fiscal 25.
Oh, wow.
Yeah, hitting $1.8 to $1.9 billion with CapEx between $850 and $900 million. They're really banking on those self-help actions and the synergies coming through.
So, okay, strong guidance despite the miss. What about volumes underpinning that? What are they assuming?
That's where they sound quite cautious, actually. They're not baking in any big rebound in consumer demand this year.
Really?
Yeah, they expect volumes to be broadly flat. They're acknowledging the tricky macro environment, the uncertainties.
Okay, so conservative on demand, maybe realistic.
Which brings us back to that Q4 miss. What specifically went wrong, and what are they doing about it? Two main things they pointed to. First, volumes were weaker than expected, sequentially, especially in North America, both flexible and rigid packaging, that overall 1.7% drop we mentioned. And second, and this seems pretty significant, the North American beverage business hit some serious operational snags.
The beverage unit. Okay.
Yeah, problems at a few high-volume sites. That really dragged things down.
And those problems caused higher costs, freight, labor.
Exactly. Higher freight, higher labor costs, and lower fixed cost absorption.
Yeah.
Basically, factories weren't running full enough.
Got it.
Management admitted they'd overflexed capacities, built up too much production capability for the demand they actually saw. Expensive mistake.
Sounds like it. Especially heading into what's usually their busiest quarter for that beverage business.
Right. So they're tackling it head on now. This North American beverage unit, it's about $1.5 billion in annual sales. They're running it as a separate, dedicated business unit now. New management focused just on that.
Okay, separating it out.
And crucially, they're exploring strategic alternatives for it.
Meaning?
Could mean restructuring, finding a partner, maybe selling it outright. It shows they're willing to prune things that aren't working or don't fit the core strategy. That kind of decisive action often unlocks value long-term, focuses the mind, you know?
Interesting. And they said selling it wouldn't hurt their overall savings targets, their procurement goals.
Yeah, they specifically clarified that, which is interesting. Suggests the savings are broad-based. The plan seems to be stabilize the beverage unit over the next, say, couple of quarters, then properly explore options, not a rushed sale.
Makes sense. Get in better shape first.
And this review isn't just the beverage unit. They've apparently identified about 10 other businesses, adding up to maybe $1 billion in sales that also don't quite fit the long-term picture.
$1 billion. Wow.
Yeah. Based on things like growth potential, margins, industry structure, their ability to really lead in those segments.
Yeah.
So the goal is clear. Simplify, focus on the core, drive more consistent organic growth, boost shareholder value.
Okay, so a lot of moving parts on the operational and strategic side.
Yeah.
How does this connect to the balance sheet, debt levels?
Good question. After the Berry deal closed, leverage was at 3.5 times, which they said was pretty much what they expected.
And the priority now?
Deleveraging, absolutely number one priority for capital. They want to get that leverage down to around 3.1 to 3.2 times over the next year. And that target doesn't assume any money coming in from selling off those businesses.
Okay, so any sale proceeds are bonus debt reduction.
Primarily, yes. That's the plan. Get the debt down first. Once they hit their long-term target range, they're aiming for 2.5 to 3.0 times for an investment grade rating. Then they'll look at other things. Share buybacks, maybe some small bolt-on deals. It's a clear roadmap. Debt first. Pretty prudent.
Right. And just circling back quickly to the overall demand picture you mentioned, they're not expecting a consumer rebound. Volumes broadly flat or pretty subdued.
Yeah, they stress that. Especially in North America, consumers are watching their wallets, looking for value. That's impacting demand.
So a challenging backdrop for sure.
Which makes that market reaction we started with even more fascinating, doesn't it? Management reiterates strong guidance for this year, talks up big synergy numbers, lays out a clear plan, and yet the stock drops 13.5% on heavy volume.
Yeah, a real disconnect there. Seems like the market just zoomed in on the Q4 miss and those specific problems in the North American beverage unit. Management is talking long-term transformation, self-help, but the market's focused on the here and now, the immediate drag. Maybe cautious constructive is the right way to put it. Seeing the potential, but worried about the current issues.
I think that captures it well. The beverage unit overhang was clearly top of mind for investors that day.
Which, naturally, leads us into our next segment. All right, time for our This Is Not Financial Advice segment. You know the drill. We pitch an outrageous but plausible trade idea, investment committee style. So given that sharp market reaction to the beverage unit's problems and the company clearly saying, we're going to fix it, then explore options, what's the angle?
Okay, here's a thought. How about this? Go long this company and pair it with a short position on a close competitor. Maybe one that doesn't have such a specific near-term catalyst like a potential divestment.
Okay, long the fixer-upper, short the steady player. What's the outrageous part?
The outrageous part is betting that they can actually turn around this publicly flagged, underperforming $1.5 billion beverage business in just, say, the next 2 quarters. That's a tall order operationally.
Right, execution risk.
Big time. But the plausible part. Management has laid out a plan. New leadership, separate unit, focused effort. If they stabilize it, and then manage to sell it or otherwise strategically resolve it.
Then what?
Well, first, you remove a major operational headache and a source of negative sentiment. That cleans up the story. Second, you likely get a chunk of cash to accelerate that deleveraging plan we talked about. Faster debt reduction is usually rewarded by the market. So the potential outcome is a re-rating of the core business the part market might be undervaluing right now because of the beverage noise.
So the trade is essentially betting on management's ability to execute the cleanup and divestment, unlocking value in the core business.
Exactly. Capturing the upside from a cleaner, more focused, less indebted company, while hedging with a short on a peer that doesn't have that specific catalyst brewing. It's a bet on focused execution.
Interesting. Outrageous, plausible, fits the bill. Okay, so let's pull it all together. We've got this company deep in a major integration, chasing big synergies, promising strong cash flow, but also grappling with immediate operational headwinds, particularly in that North American beverage segment. They're taking clear steps, though. Portfolio review, deleveraging focus, addressing the problem areas. A multi-year plan seems in place.
Yeah, and while the market zeroed in on the Q4 stumble and the beverage issues, management's projecting confidence. Confidence in hitting those long-term goals through their own actions, the self-help, and realizing those integration savings. It's definitely a situation to watch closely. The execution is everything now.
We've definitely thrown a lot at you today. And remember, this deep dive, it's purely for informational purposes, definitely not financial advice. But it does make you think, doesn't it? In this age of instant information, instant reactions, are we sometimes too quick to judge based on one quarter's results? Do we sometimes miss the bigger picture, the multi-year transformations happening just beneath the surface? What really stands out to you from this call? We encourage you to keep digging into these dynamics, the numbers, the strategy, the market psychology. They're rarely simple.